Welcome, folks. I'm Bob Benny.
I'm Jesse Thompson.
We're with Bob Benny Wealth Management right here in Lincoln, Nebraska. And we're here for today's webinar, monthly webinar. This is Thursday, September 21st, 2023. And our topic for today is investing for today, 5 critical insights about the economy and market. And so go ahead and tell them how to ask questions, Jess.
If you have any questions, there's a box at the bottom of your screen that you can type those into, and we'll address all of them at the end.
Yeah. Well, like I said, it's 5 critical insights about the economy and market. When we're talking about the market, generally, we're talking about the stock market. Oftentimes, what we use as a measure of the market is the S&P 500, which is?
It's an index made up of the 500 largest stocks on the New York Stock Exchange, largest American companies.
Yeah. So go ahead.
Yeah. So the market has done around 15% so far.
This
year to date, the S&P 500 has. And there's always going to be a lot of noise surrounding what the market is doing and what the economy is doing. You can look on any financial news website and see all kinds of different headlines about that there's going to be a recession or there's going to be a crash, and those headlines are going to be there no matter what's going on in the market or the economy. There's just a lot of noise. So it's our job as your financial advisors or as financial advisors to kind of help you wade through all of that stuff, all of that noise, and provide some perspective and truth about how things really are. So there's always going to be, I'm going to start our slideshow for us here.
Some news media. There's always going to be some news media experts, some market experts, and they're not really experts on the market. They're usually people that all they have are journalism degrees. They don't know, they report, but they're usually not right. In fact, they're wrong more than 50% of the time, aren't they, Jess?
Right. And some of these people are market analysts that are hired by certain companies or banks or something like that. But all of these experts together, there's been studies that have been done on them and how accurate their predictions are about what the stock market is going to do, or maybe what a particular stock or company is going to do in the short term. And they're actually wrong a little bit more than half the time. So you could literally flip a coin and get probably the same results as what their predictions are giving. So that's just something really important to remember, because I think we see these headlines and we think, oh my gosh, is there going to be a next market crash coming? Or is this the next hot stock? Am I going to miss out on it if I don't buy it right now because so-and-so is, maybe he must be smarter than me because he's a market analyst hired by this big fund company.
Or he has a TV show like in the upper right-hand corner there. Jim Cramer, he's been on CNBC and has his own show for decades, it seems like. And he definitely is somebody that has proven himself to be wrong more often than he's right, by far wrong more often than he's right. But he keeps having a show and he keeps being on there. And so the reason he has the show is because he keeps getting viewers, not because he's right. He gets viewers because he's bold and he's flamboyant and all that stuff. Tell him about his most recent biggest mistake, gigantic mistake.
It's up there, but that Silicon Valley Bank that crashed earlier this year, that was all in the news and was a huge deal. Jim Cramer told his viewers on his show that stock was a buy about 3 weeks before the entire thing went under. He's a
doofus. And so yet he has a show. And the other one is a guy named Michael Burry. Some of you may or may not have ever heard about him. He's the guy that wrote The
Big Short.
Yeah, wrote the book The Big Short, and he was right about that, but he's been wrong ever since, predicting market crashes.
And he's always, all of his predictions are bearish on the market. They're always that there's going to be this next big thing. And because the 2008 crash was so bad and he was right, every time he makes a prediction, it makes the news and people worry and things like that. But he's made so many of them and they've all been wrong. In fact, the last 5 predictions that he's made that there's going to be a big market crash, which have happened only in he's made 5 predictions like that and shorted the market in the last 4 years. And every time after he's made a prediction right like that and shorted the S&P 500 has gone up on average 15% in the next 6 months after he's done something like that. So again, just because you think that these people are experts or maybe they have some kind of education, doesn't mean that they're going to be right with their predictions, because it's impossible to predict short-term movements in the stock market or in it with particular companies, because there's so many factors that come into play with stock market pricing that are completely out of our control and are completely unpredictable, as this slide
I
shows.
always get a kick out of, in the whatever 27 years since I've been doing this, Jesse, you always see in the financial news media about the market went up because of, and they'll name one thing, or it went down because of, and they'll name another thing. Fact of the matter is, any given day, the market's going up because there's more people buying than selling, or the market's going down because there's more people selling than buying. And each of those many of those people have many different reasons that they're doing it. And so, maybe when the news media says the market's going up or down because of one thing, that may be one thing that led to the market going up or down, but there's all kinds of other things that are taking place too.
And so what should somebody do? How does somebody invest if the market's unpredictable? So we have some general investing principles that we suggest that people use and that we use when we help you invest your money.
So we recommend that basically it has to do with not making investment decisions because of emotions. The emotions that people use that always get them into trouble with investing are fear or greed. Fear causes people to sell when they should be buying, and greed causes people to buy when they should be selling. And so what we do is we help people make logical decisions, looking at their long-term outlook and their long-term goals. And we don't let emotions or what's going on in the news or in social media cloud our judgment.
Yep, and we take a look at the big picture of what's going on in the economy when we're looking at all that as well. And while the stock market is unpredictable, and the price movements are unpredictable in the short term, there's certain clues that the stock market and the economy can give us that shows what the actual health, kind of gives us a gauge on the actual health of the underlying companies in the stock market and how healthy their earnings and profits are right now. And that is more important for the long term than temporary price movements.
So let's start talking about some of these insights, these 5 critical insights that we have that are kind of our basis for our talk today, Jess.
Okay, so the first one.
Insight number 1, the economy is resilient and recession fears are easing. Well, we haven't been fearful of a recession. The news media has been talking a lot about a potential recession for a year plus. We haven't seen it. We haven't been expecting that to happen, and we think it's been overblown. And so far, it seems like it has been overblown, and the fears of it are easing, and the market and the economy keep on churning along.
Yep, and some indicators of this, 2 big indicators of kind of how our economy is doing as a whole are the GDP and then also the unemployment rate. And so the gross domestic product has been positive year to date. In the last 2 quarters, it's been around 2% growth that we've seen, and good numbers for perspective are between 2 and 3% are healthy numbers. And that is largely due to consumer spending and business investment are the main things that are chugging that along. And so both of those are really positive for economic growth. Secondly, the labor market is good. There's about 1.7 jobs for every unemployed person in the US right now. The unemployment rate is 3.8%, and that's around a 40-year low. It's better than pre-pandemic levels. So that 3.8% is a really good unemployment rate as well. So if these two things were poor, they might be indicators that recession might be on the horizon, but they're not. They're both doing really good. And even so, if there was a recession, and we've talked about this before, recessions for the stock market are not doom and gloom. A lot of people think that a recession means that there's a stock market crash coming. And historically, that's just not the case. Historically, I think people think back to 2008 when those things coincided with each other, but that's not how it's been for every recession historically. And typically recessions are short-lived. They don't have that big of an impact on the stock market for a long period of time, and the stock market recovers really quickly after the recession is over as well.
Right.
This insight about the economy affects sentiment for investors and consumers, most importantly. So most importantly, when investors are fearful of recession, they'll often sell or move to cash and hoard money. They won't spend money, and Americans are still spending money.
They sure are.
And when they feel optimistic, they'll buy stocks and they'll buy stuff. And that's something we'll get to in a little bit that we also saw with company earnings, is that the consumer discretionary the consumer discretionary sector did really well as well.
Yeah,
So
back on here.
Yeah, I am not sure where I messed up, if that was a me error or a PowerPoint error. So let's go on to
There we go.
insight number 2.
Insight number 2. Inflation is still a problem. Inflation is not a problem. Inflation is the greatest financial problem, financial threat facing all of us in the country and all of us in the world. And it's because the federal government printed so much money. Out of thin air, they added over 30% to the supply of US dollars in the last about 3 years approximately.
That's what you see on this chart right here. This is a chart of the money supply since 1960. And just for perspective, this is what's happened since COVID relief measures.
Yeah.
And this is that 30% bump in the money supply.
And so what the inevitable result of the government adding all these dollars into the world system is super duper high inflation. Not the 2 or 3% inflation that we're used to, but the extremely high inflation that we experienced. Some of you experienced because you were around when I was in the late 70s and early 80s. I was just getting out of high school in the late 70s, but I remember the inflation, and many of you do too. And if you don't, you can look it up and look at the historical inflation rates. It was crazy, and it was getting into double-digit inflation for some years. And so what happens when when the government adds too many dollars too quickly to the money supply is prices go up. The price of goods and services that we all buy keep going up, probably in a double-digit way. The news media and the financial news media and the government are not telling us how much they're really going up. But all you have to do is go out and buy stuff, and you're usually shocked at how much something went up in no time at all, or have something built or added to your house, or buy a new car, or buy new furniture, or whatever. All these things are going up in the double digits, in 10% or better. And so
in August, for example, gas prices went up like 10.6% just in that month. Just in
the month of August.
Yeah.
So there are solutions for investors, and there's good things to have your money invested in, and areas that you shouldn't have money invested in when there's high inflation. The best assets, the best categories of assets to have money in when there's high inflation are companies, stocks, stock mutual funds, stock ETFs, income producing real estate, and then gold. Those are the 3 best: companies, real estate, and gold. Companies by far historically have been the best hedge against inflation, And it's logical from the standpoint of, if you think about what inflation is, it's the rising costs of goods and services. Well, doesn't it make sense then logically that owning the companies that produce the goods and services whose prices are going up, that's logical? Well, it also bears itself out in history. In the late 70s and early 80s, when we had super high inflation before, and when we had super high rising interest rates on mortgages got as high as 18%. But when we had double-digit inflation for some years, the best performing asset class that beat inflation big time was stocks or companies. The second, and they beat companies by about 8% a year. The second beat inflation. I'm sorry. Companies the stock market beat inflation by about 8% a year. Income producing real estate beat inflation by 1 or 2% a year. And then gold was basically flat. Don't like gold as much as income producing real estate or companies, because gold doesn't produce any rent, and gold doesn't produce any goods or services that they're selling at a profit like companies do.
It's also a really volatile asset. And so you think of gold as something that maybe won't be moving up and down in price as much as the stock market, but it moves up and down in price a lot.
Yeah.
And a lot of people just go to gold when they're fearful. And so gold as an asset does okay during like uncertain market times, but since it doesn't produce a good or a service, it doesn't really grow. So,
right.
Okay, so I want to show a quick chart on those different kinds of assets and returns before we get to some more solutions, just so that you can see historically what these different asset types have done. So this is from 1970 to 2022. And this doesn't include, I couldn't find one that included real estate, but this is different kinds of stocks, companies, bonds, gold, and cash. And it's looking at the total returns and the real returns for these different asset classes. The real returns are what we're concerned about. Those are the returns that are adjusted for inflation. They're the after inflation returns. So you don't have to look so much at this busy chart, but if you just look at the real returns for these different asset classes here, small cap stocks, which are more volatile as companies still though, is about 8%. The S&P 500 real return after inflation for this. So this is the average annual return over this entire time. This isn't just looking at the years of highest inflation, but these are inflation adjusted numbers, which is important long term. The S&P 500 was about 6.5%. Bonds only did about 3%. Treasury bills were worse, and gold did about almost 4%. And so again, companies have performed the best relative to inflation over a long-term period of time.
And that's so this is over, this whatever that is, 40-year period, 50-year period, 52-year period, which included time periods of high inflation and low inflation. In the high inflationary periods, companies outperformed by far, and then real estate and then gold was about flat.
And so some other things that you can do about inflation. Maybe. I'm just going to say them because this slideshow's not working.
All right.
So the other things that you can do about inflation is you can contribute to before tax accounts. So another way that inflation affects people that we don't really think about is that maybe you're making more money, but you can also be bumped into a higher tax bracket because you make more money. And you're also, another way that you're getting taxed that you don't really think about is that you're paying more for stuff, and the percentage of sales tax that you have to pay on that stuff is more as well when there's inflation. So some kind of ways that you can protect yourself from taxes, at least the income tax aspect of it, is to contribute to accounts like a 401k, an IRA, an HSA, tax deductible accounts like that.
Yeah. Finally, don't hold large amounts of cash, because we're not necessarily talking about having cash in your house or in your safe, but that it includes that. We're talking about cash, meaning cash and savings accounts, checking accounts, money market accounts, those kind of things, because you just lose buying power with them. For instance, if you have $100,000 in the bank, and it's earning a little piddly amount of interest, but it is earning a little bit of interest. And if there's, say, 10% inflation, a year from now, I mean, today you could buy $100,000 worth of goods and services, but if there's 10% inflation, next year you'll only be able to buy $90,000 worth of that same stuff, and so on and so forth. So one of the keys is not to hold a lot of cash when there's a high inflationary time like we're in right now. So slide number,
Our insight number three.
Insight number three. I'm sorry, not slide number three. Insight number three is interest rates must get higher and aren't going anywhere. So they're going to keep going up. The reason is because the only solution for the government for this high inflation is to raise short-term interest rates that they're in control of. That's their only tool, other than lying and telling people, don't worry about it, it's not going to happen or whatever, is to raise interest rates. And so they have raised interest rates in a little over a year by about 5.5%. And so they're going to keep going up. This is what they did in the late 70s and early 80s, was to try to head off inflation, was raise interest rates. And that's what they'll keep doing. They did pause yesterday and stopped raising. They didn't raise in August. They didn't raise in September, but they did say that they're going to keep raising and that they're not going to start cutting rates for a while. And so I believe that because of all this money printed, that inevitably leads to super duper high inflation, double-digit inflation, and the high inflation inevitably results in higher interest rates, and they're going to keep going up.
And so some things for investors to be aware of when interest rates are going up, like they are right now, is that now is a good time to own short-term treasury bills. So these are treasury bills that only last from 3 months to a year tops. The interest rate on these right now are really good. They're like 5.45% about, which is better than what you can get at a CD in any bank that I've heard of.
Yeah.
Right now they're liquid.
Yep,
they're also liquid, which is really nice. And you can turn them over as interest rates go up and get a higher interest rate on them. Something that is very unwise to own right now is long-term bonds. So right now is a terrible time to own long-term bonds or bond mutual funds.
Because as bonds and go back to the big screen, would you? Interest rates and bond prices are like a teeter-totter. If interest rates are over here and bond market values are over here, as interest rates go up, bond market prices go down, and the longer term of the bond it fluctuates more. So a short-term bond, which would be up by my shoulder on this teeter-totter, it isn't going to fluctuate. The market value of it isn't going to fluctuate very much, but a long-term bond, it can go down substantially. Do you have a chart on that too?
Yep, I do. So you know how we talked about earlier how there are a lot of things that are completely unpredictable that influence pricing in the stock market. Well, when it comes to the bond market, the way that prices are going to be influenced by interest rates are completely predictable and calculable. Like it's a literal mathematical equation that you can do that will show how much a certain raise in interest rates will affect the price of your bond. And here's an example of that.
Okay, so this is just showing you the price drop of different kinds of bonds, short-term versus, I wouldn't call a 10-year bond a long-term bond, but it's longer term than 6 months. So they're showing here in the blue, with the blue bar, they're showing the fluctuation in price of a 6-month bond. And in the, what color is that?
I think it's supposed to be green, but
pea green, whatever that is.
It's ugly.
Bar, that's a 10-year bond. So with a 1% rise in interest rates, the 10-year bond would go down about just under 10%, say 9%. in market value. The 6-month bond would be relatively unaffected. And then when you get out to 3%, look at how much the market value of a 10-year bond would go down with a 3% increase in interest rates. Market value of a 10-year bond would go down 25%. So anyway, just stay away from unless you think that interest rates are going to stop going up, do not buy any long-term bonds. That's our advice.
All right. And our insight number 4.
Insight number 4 is that the top 500 U.S. company earnings are strong and better than expected again. And that's great news. That's great news for the economy, and that's great news for the markets, because it's ultimately all about earnings with stock prices and the stock markets.
Yep. And the Q2 earnings, just those come out. So all of these companies report their earnings, of course, every quarter. The most recent ones that came out, 80% of the companies on the S&P 500 did better than what they thought they were going to do, almost 8% above expectations.
That's
and
big.
That's the biggest earnings surprise rate, I guess, since 2021. They're up 1.6% from the quarter before, from first quarter of this year. And the outlooks on earnings from these companies for the third quarter and the fourth quarter of this year are also positive for the first time since 2021 as well. So all of that is good news.
And like I said just before this, the ultimate value of companies that you buy has to do with their earnings. And if their earnings are going up, their values are going up. Even though there's all this noise in the news that causes people to buy and sell, the ultimate value of companies has to do with their earnings, and the earnings are going up, and the earnings are very healthy. So this is insight number 5. Is that what we're going to now?
Yep, we're on the last one.
On the last one. So insight number 5, push for ESG. That stands for environmental, social, governance, and DEI. Diversity, equity, and inclusion.
He can read. I just have this box in front of the word.
are fading in the corporate marketplace. So what we mean by that's an insight, that's an important insight, is that some of these companies were really kind of getting into this stuff and really touting and focusing their overall efforts on this ESG and DEI stuff, political things, social things, rather than focusing on making money. And what happens when companies don't focus on making money is they don't make that much money.
This is proven, by the way.
Yeah.
We showed some information on this on a prior webinar,
but so for instance, Bud Light, the Bud Light marketing people and the Anheuser-Busch people made a gigantic mistake with trying to promote Bud Light to transgender people, and they upset their customers.
Their larger customer base.
Yeah, their big customer base, which is
part of their
non-transgender people, apparently. and so that stock price went, Anheuser-Busch's stock price has gone down 14% since then. Very similar thing happened with Target, because they were really promoting LGBTQ stuff, and that affected them. It's the same thing, folks, that happened with that Silicon Valley Bank. The Silicon Valley Bank, the big bank that failed back in the spring, they were focusing on political things rather than focusing on normal banking practices, and they made some really stupid, dumb mistakes. They invested their excess deposits in long-term treasury bills, which are 30-year treasury bills, which are safe if you hold them to maturity, but they invested money that they had to be able to give people the money back because it was deposit money the next day in 30-year treasuries. It ended up causing that bank to collapse. I won't go into the details of it like I have in the past, but we have.
So some details on why we think this whole ESG DEI thing is fading from the landscape of these corporations. The number of S&P 500 companies who cited ESG as one of their main corporate goals last quarter went down 30% from last year at this time. Something that you've probably heard of that's important and very interesting, I think, to note is that there are 3 major investment fund companies that own over 25% of the shares of the S&P 500. Those companies are BlackRock, Vanguard, and State Street. And historically, those companies have used their ownership share and the power that they hold over those companies to encourage them to incorporate ESG, DEI, and climate principles, basically, into their corporate goals. And these companies have been under pressure by the House Judiciary Committee because of antitrust laws and the influence that they have over so many companies and their collusion to push these different policies, these social policies on companies. BlackRock reported a loss of $4 billion in managed assets tied to this ESG backlash. And I believe it was the state of Florida completely pulled all of their retirement pension programs away from BlackRock. So they're losing the market's kind of taking care of this. Yeah. The free market is where they're losing. This ESG stuff is losing money, and so these companies are backing off of it. Vanguard also pulled out from this net zero climate program that it was in. BlackRock and State Street are still in it, but Vanguard pulled out of it. And so this is good news for shareholders because it means that these corporations are going to be able to focus more on profits than have these distractions of these different climate social political agendas that they have to worry about.
And it's not so much about focus on profits and ignoring the environment or anything like that. They're focusing on providing value to their customers and providing them with a good or a service that they'll pay for and that they'll like, and not focusing on some people's political agenda that may not fit all of their customers.
Yeah, it's not fair to the other shareholders.
Right.
So go ahead, and if you have any questions right now, we're going to kind of summarize everything really quickly and then close up. If you have any questions, go ahead and type them now. We'll answer them in just a second.
So overall, we feel very optimistic about the economy and the markets, especially the United States stock market right now. We do not feel optimistic about foreign companies. And so we try to stay away from individual foreign stocks or ETFs that are made up or indexes that are made up of foreign stocks. We also don't feel optimistic about long-term bonds at all. If somebody wants to keep some money very liquid and not have to worry about any stock market volatility, we recommend very short-term treasury bonds, 3, 6, 9 months, 1 year at the most, maybe. And our job as your financial advisor or as financial advisors is to help you make logical financial decisions based on our experience and history and fact and our analysis of things, not based on any kind of emotional decisions like fear or greed or stuff like that, and just help you to have long-term success. We help people with all kinds of things, not just investments, but with tax strategies, estate planning, retirement income planning, anything to do with money or finances. We want to help you. And so if you or any of your friends or family have any questions, please don't hesitate to give me and Jesse or our office a call, and we'll try to help you.
All right.
So do we have any questions?
Things up. No questions. Well, thank you, everybody, for your time, and hope you have a good rest of your week.
Have a blessed day. See ya.
Bye.